Get you a date. Friday, March 5th. No, April 5th. Okay. And then we'll do starting on sampling overview. We might even finish sampling overview. We'll see. It's not as long as the other ones. Okay. Oh, yeah. So multiple choice for the extra credit. We'll do that. It's a Chapter 6 handout. All right. So let's go to the Chapter 6 handout. I'm going to talk more about this later too, but there's one thing I just want to reemphasize for materiality, and to see if something's material or immaterial. That there are two hurdles for it. One is quantitative and one is qualitative. And the quantitative is what we think of normally as how many dollars, is it 50,000, is it 200,000, or what's the dollar amount? But the qualitative is also very important because it matters what the misstatement is, whether it's material or not. And so if it does any of these things, if it violates a contract, if it reverses a trend, changes a loss to a gain, all this kind of stuff, it depends on the nature of it. So it isn't that all misstatements are the same. And by the way, that's why when the CPA exam, they don't ask you to determine whether something's material. It's a judgment call. Excuse me. But and so what they will do though is they'll tell you that it's material or it's not material, and you just have to go with that. Don't question whether it's material or immaterial. If they say it's a $5,000 error and it's material, and it could be material because of the dollar amount. It could be material because it's upper management committing a fraud or something like that. But they'll tell you whether it's material or immaterial. I've never seen them. I've never known that they've ever asked, here's a dollar amount, is this material or not? Because that's a judgment call, and rational people will make two different judgments of whether that's material or not. So anyway, a lot of times, when they do give you things that are misstated and they say it's material or immaterial, you just take it the way it is. You don't have to check on to see if it's material or not. Just take it the way it is. Okay, types of evidence. This is, my page might be messed up, but it's probably page 9 or maybe it's page 8. I don't know. But types of evidence, number 4. So when you're doing your audit, you're collecting all this evidence, and this evidence is almost like you're going into court. Because you might be drugged into court. If something goes wrong with the audit, it might be that you end up in court, and you're going to have evidence to show, well, here, look what we did. We did this, this, and this, to back up your audit opinion. So the evidence you're collecting, it's all there to back up your opinion, and it's almost like preparing for a court case. And that if someone asks you, "Did you look at this?" you can pull out, "Yes, I did. Here it is. This is what we did." So you're collecting all this evidence. And so going through what type of evidence you're going to be collecting, you're going to have that in your audit plan, that you're going to collect this evidence, and those go into the auditor's work papers that they use for their evidence. Okay. And if you look at some of these types of evidence, some of them are things that you would normally think of. Inspection of record, that's what probably most people think of. You look at the invoices and all that kind of stuff. Inspection of tangible assets, you might go out on the floor and take a look and see what inventory they have, make sure it's on the books. Yeah, and we'll talk more about that in a little bit here. But a lot of these are things that normally people don't think about as audit evidence, but they're actually very important. Observation, watching what people are doing. Inquiry, asking people stuff. you actually do quite a bit of interviewing when you're an auditor. Confirmation, I think we talked about that in evidence, confirmations. Recalculation. Well, here, let me write some examples in here. So, for instance, observations, you might look at how employees are processing returns. Um, So observation, you might observe how employees are processing returns. Inquiry, you might ask customer service manager how returns are processed. And there might be a discrepancy between these two. Confirmations, we talked about that. For instance, and we're confirming accounts receivable. We have positive and negative confirmations. We'll talk about that in chapter 5. Recalculations, depreciation expense. See how they calculate depreciation. Reperformance. This would be, well, let's take the process of returns. You're actually, one of the good ways to see how it's done is, the idea is to do it yourself. Analytical procedures, we already talked about those, I think, did we? Oh, yeah. Yeah, we did. There you go. Analytical procedures, you're going to look at scanning data. Scanning data. Look for odd entries. For instance, if you had an entry that had a credit for revenue and a debit for expense, that hardly, I can't think of any way that would happen. You may also be looking for entries for round, that's not how you spell numbers. Entries for round numbers. One of the strange things about fraud is a lot of times they do it for nice big round numbers. Most transactions are, $50,972.22. You don't even have transactions for 50,000 or 60,000 or nice big round numbers. It's usually not, because most transactions don't happen that way. It's very odd. It's possible they could happen that way, but for the most part, it doesn't. So when you run into those kind of transactions, a lot of times you want to look deeper into that, because that is often fraud. I shouldn't say it's often fraud, but it's more likely than other numbers to be fraud if they're nice big round numbers. And it is a strange thing, though, that people who commit fraud a lot of times will make nice big round numbers to come out 25,000, 50,000, things like that. Okay. Okay, so entries that are not made in the usual journal. So, for instance, they're a sales journal. A sales journal is just most companies make a lot. If they make any number of sales, they'll have a sales journal. Instead of making a journal entry for everyone that comes in, you can imagine Walmart making a journal entry for everyone that checks out and buys a whatever gallon of milk. That they're going to make a journal entry for that. What they usually do is they will have those go into what they call a sales journal. The sales journal will total up the numbers, and so the numbers for that store for the end of the day will be sent in, and those will go into the sales for Walmart. So you have this special journal. They call them special journals sometimes, but it's a sales journal, and it'll have also. So if there's a sale that comes through that's not in one of these special journals that you normally think it would be in, that raises questions, right? So if it doesn't come from the sales journal, they're counting it as a sale, you need to look into that and see why it didn't go through the sales journal, where usually they do go through. But there'll be special journals in large companies for everything. Sales journal for accounts receivable, accounts payable, all that kind of stuff. They all have their own special journals for those. And those are what should go through to the ledgers. So when they have entries that are not made in the you want to look into those. Test of controls, we're going to talk about that today. Substantive tests, we've talked about those. Those are classical sampling and monetary unit sampling. Those are for dollars. Ready for those? Okay. I'm going to put in one more thing here. Types of evidence. As far as quality of evidence, give me 1 second here while I learn how to use a computer. Audit obtained directly from the auditor is more persuasive than evidence provided by the client. So, for instance, inspection by records, of records or documents. Notice that these records or documents are done by the client. This is sort of secondhand. So inspecting records or documents it's evidence, but it's not the best evidence. So this is going to be better evidence down here. This is what the auditors look at. Better evidence. Observations, better evidence. So when we watch somebody doing something, it's better. Inquiry, notice where that's coming from the client. That's not us actually looking at it. We observe it, it's better evidence. We do ourselves. Asking somebody about it is not as good. Confirmation of accounts receivable, this would be better evidence because this is coming, the auditors are picking out the accounts receivable to set in. Recalculation, these are better evidence. Analytical procedures, better evidence. Auditors are doing it. These will all be better evidence. We're doing it. We do those ourselves, so these will be better evidence. Well, this would also be better evidence. So scanning the journals, because you're doing that yourself. You're not asking them to scan the journals and asking them if there's anything unusual in the journals. You're doing it yourself. So a lot of these things are the better evidence are going to be those things that are done by the auditors. Less likely are less persuasive are those things that you get secondhand, things like records and documents, asking people about stuff. You still do that, and you do that because you're going to try to corroborate what they're telling you. But your best evidence comes from what comes from the auditors themselves. Okay. Any question on that? So not all evidence is the same. It's all, it depends on what it is. And usually when the client tells you something, you start looking for evidence that corroborates that. So if the client tells you, okay, customer returns the customer service manager has to approve the customer returns for anything over $50 or whatever. Okay, you got that information. Now you got to kind of go check and observe to see if that's actually happening. All right, or if it's happening the way that they think it's happening. Someone returns 3 different things, and one's for $40, one's for $30, and one's for $20. They say, well, no, none of them are $50. You run into those kind of weird things that people might not be interpreting the way that they should be. I think we talked about assertions already. I think we talked about in chapter 5. I'm going to skip this. I'm almost positive we talked about these, but we are going to go through how we use these. Okay, so this is how the assertions kind of come into play. So substantive audit test plan for asset accounts. Well, we want to see if they exist. So let's give an example. Let's say for inventory. Oops. All right. Well, see if they exist. They have the asset on the books. They have the inventory on the books. So you should be able to go to the from the books and go to the floor and see if they actually exist. So they say that they have 500. I don't know, motorcycle. I don't know. Words failing me. So you can go to the book to the book to floor, so you can see. Okay, they have these on their books. Do they actually exist? We go find it on the floor. Completeness is just the opposite. If you find something on the floor, you got to see if it's on the books. Established they have the rights to the asset. Just because it's on the floor doesn't mean they own it. Or it could be that it's pledged as collateral for the bank. Cut off, when did they get the inventory? And for things like inventory, you're going to look at sales cutoff. And you're also going to look at purchasing receiving cutoff. Oops. Okay. So sales cutoff, inventory, what inventory was sold at year end. The inventory that's sold will obviously not be in the inventory on their balance sheet. Those things that come in at year end, making sure that those are cut off, that whenever the last one comes in at December 31st, whatever it is, that there's a cutoff for there. Determine the appropriate valuation of the asset. And then presentation and disclosure. Virtually everything has to be disclosed in the footnotes is usually what we're looking at here. I can tell you for inventory, the valuation is, if I was going to create a fraud for inventory, I'd do it with valuation because I'm a sinister person. No, the reason being is that a lot of times the inventory count, if you're doing it by inventory count, if you're doing it by inventory count, the that can get caught. So if there's inventory count, if you get the count of the inventory is, it can be a lot more tricky to do that because once it gets caught, it's very different. Then the audit really falls apart. But if you do it through, leave the count alone. But if you did it through altering, say, invoices and things like that to make the inventory look like it was more expensive coming in, notice that it's a dollar amount on the books. It's not a count of the inventory on the books. It's a dollar amount. So if you're trying to inflate that dollar amount, the best way to inflate that dollar amount is the easiest way to do it is just to change the valuation of it rather than changing the count, because the count can get caught. So, have people fake the count? Yeah. But the count can get caught, whereas the pricing of it is much more difficult to do. And so, and remember, and again, on the financial statements, we're only looking at dollars. So, saying that you have 10% more merchandise, that could be caught easier. Increasing the price by 10%, manipulating the invoices and things like that come in, that is one of those things that might be, it might be easier to increase the value of your inventory that way rather than doing it through the count. So you gotta be careful when you're going through these things of how they're, you gotta think like a fraudster. I'll tell you something else kind of funny. When we go into place, I was in internal auditing. When we'd go into a place, and they gave me whatever I was supposed to do. I'd go through the steps of everything to do, and then I would just sit there and say, well, if I was this person, what would I do? Suppose I wanted to order something and no one would ever find it. I could leave with it, no one would ever find it. What would I do? And you sit there and go through it, thinking of what they would go through, and never underestimate. Who remember people that are working these jobs. They're there every day. So they can actually have a lot of time to think about things. All right. Okay, the transaction cycles. This is something that came about fairly recently. Well, I shouldn't say that. It's always been around, the idea of accounting cycles. And you might wonder, well, what are you talking about, accounting cycles versus what? And it's kind of accounting cycles versus auditing accounts. The actual tests are exactly the same. Nothing has changed. But what some auditors have decided to do is to look at the cycles rather than simply the account. They feel it's a better understanding of the business if you look at the entire cycle. So, for instance, the revenue cycle, sales and collections. Now, notice the collections are going to be cash. So, if you're doing an audit and you're doing the account cash, you're going to do some procedures for collections. Well, this is a little bit different in that they say, okay, we're going to look at the revenue cycle, and the only part of cash we're going to look at are the collection part, but the actual sale itself, how those procedures and how that comes about, and then work it through to the collection of the cash. The actual audit steps for the different accounts has not changed. It's just that they kind of break it up and put it over. So, for instance, the cash account would be in the revenue cycle. It'd be in the acquisition cycle, be in the conversion cycle, be in the payroll cycle, be in the investing cycle, and be in the financing cycle. So you'd have that split up among the different cycles. It's just a different way of looking at it. All the tests are exactly the same. So it isn't such a big difference, but it is a way of looking at it. And the idea is that if you see the entire cycle, it might make more sense when you're doing the audit. Just a little bit of history on it. This is the way Price Waterhouse used to do it. Now, it used to be everyone did the account. There used to be, I'm talking ancient history here, but the big four accounting firms for auditing, they use the big four CPA firms. There used to be the big eight, and in the big eight, there were 7 firms that did basically accounts. Looking at the accounts for the most part. And then there was Price Waterhouse that did the cycles. And if you ran into somebody from Price Waterhouse, it was all about the accounting cycles. And they did that for years. And just to let you know, here's kind of another quirky thing. Price Waterhouse was sort of like the Rolls Royce of CPA firms. They charged the most. They had very few customers because they charged a lot. But they were the only ones that did this accounting cycle thing, and for the most part they did mostly banking stuff, but they were very much into the cycles rather than the accounts. And again, their audits, whenever they would do comparisons of audit fees, they'd always throw out Price Waterhouse because their fees would be twice as much as everybody else's. Okay. Audit documentation. Who owns the documentation? The auditors. So the auditors own the documentation. It's your evidence if you be brought into court. So this is This is evidence to support the auditor's opinion. So you own those work papers, and this is the client may say, "Well, I want a copy of the work papers." You don't give it to them. I mean, if they want to know certain things, that they have a reason to know something, but you don't just give them the entire audit work papers, and for a number of reasons, that not the least of which is that they would see how what you're doing for your audit, and they could alter their plans and somehow cook the books in the future. All right. And why do we have it? We have it for proof of planning the audit. Support for the audit report is probably the most important one. And there's also working paper reviews, which we'll talk about in a little bit here. So, proof of planning the audit to make sure that you cover all the bases and all that kind of stuff. Proof of that. Support. And then also that someone else can take a look at it and see what you did and see if basically where there are going to be areas of improvement. This is a quality control. It's one of those things that, okay, the auditors check to make sure people are doing their, creating their financial statements appropriately. Well, who's checking on the auditors? Who's auditing the auditors? And that's where the quality control comes in. Okay, permanent file. I'm not going to get too much into these. You can read through these. These are files that you keep for every year. And they're basically things that are, that every audit you would have I'll say junior contracts as declared contracts, but anyway, these are just things that you'd have from year to year. You're not going to get their corporate charter every year. The first year you might get their corporate charter, make sure that they're following that. The chart of accounts, that's probably not going to change too much. Organizational chart, you'll update that every year. These are things you just do from year to year. The current audit are only things that are used in the current year. So, for instance, adjusting entries. You're not going to do the same adjusting entries every year. It depends on what the audit comes out. If just because the sales were off last year doesn't mean they're going to be off this year, and that sort of thing. So these are ones only for the current year. You can look through those. Okay, now here is the. You get a problem like this on the test, by the way. Yeah. Contrasting quantitative and qualitative materiality. During the audit, my team discovers an understatement of $50,000 in an expense account. Sorry about that. I feel like I'm going to sneeze. All right. Okay, so you found a $50,000 understatement. Here's the accounts. Here's their income. Here's the total assets. Overall materiality is 70,000. So quantitatively, is this understatement a material misstatement? Dollar-wise, is this is it material? Oops.
It's not.
No,
And is it just because it's lower than the 70,000? That's the overall materiality.
exactly.
Okay. Mm-mm.
Uh, 50,000. Okay, no, so this is not material. If the materiality is 70,000, this is off by 50. It's less, it's not material. Qualitatively, okay, so here let's see what what these accounts should be. Let me say corrected. So this will still be 2.8 million. Oops. The expenses, well, these are understated by 50,000. So if we add 50,000 onto this, the expenses become 2.8. What did I do here? Hold on. $2,830,000. And our net income would actually be a net loss of okay, so it's not material quantitatively. Is it material? Is it material qualitatively?
Would it be yes? Because it brings us from a profit to a loss?
Yep. The loss. It could also be that it changes the trend. It could be, but it definitely is. A company that is profitable is different than a company that's not profitable. So this would be, even though it's not quantitatively material, it is qualitatively material in that what it actually is it's changing, like you said, a profit to a loss.
Can you give us like another example of something that'd be a qualitative material misstatement?
Yeah, if it violated a contract, if it was made to increase the salaries of management, so even if it's not material, but let's say if it's material dollar wise, it's material. Period. Okay. If it's less than that dollar threshold, it might still be material if it violates a contract. So if there's a contract that says um, you can't have consigned materials on hand, and you have consigned materials on hand, it violates a contract. Even though it might not be material dollar wise, if it violates a contract, it could be material because someone's going to be reading that report and they might want to see if the company is complying with their contract. Who's going to use the audit report? It could be something like, for instance, for increasing management compensation. Okay, our sales were we just missed the sales number. If we got that sales number, we'd all get bonuses of $5,000. Well, let's fudge the numbers a little bit. Not material, quantitatively. But we'll fudge the numbers a little bit so that we can all get our bonuses, and that even though it's an immaterial quantitatively, it might make it qualitatively because it basically changes the contract with the employees. So anytime there's anything in there, and that's what we're talking about when we do these. Yeah, I have it up here somewhere. This is ways back. Yeah, so these things, I'm going to copy these down here. So anytime you have any of these, this is a qualitative. In this case, changes a loss to a gain. They cooked the books by 50,000. It changed this net income from -30, a loss, to a positive. Anytime you have management fraud or concealing a fraud, increasing management compensation. This one's a little bit odd. I'll talk about it though. Misstatement due to fact rather than an estimate. It comes from in sampling. You know how we do the estimate? We do a projected misstatement. Okay, we project that this is misstated by whatever 50,000. That is a projection. It's made on on statistically. If there is a misstatement of whatever $50,000, but it's based on a fact that there is something that this single account is wrong. This is misstated. The single account is wrong by $50,000. That carries more weight than an estimate. So basically, what they're saying there is that an actual loss compared to an estimated loss, the actual loss carries more weight because you can actually point to it and say this is exactly what it's off by. Whereas an estimate, it could be your sample is off. If you're auditing at the 95% level, 5% of the time you're going to be wrong. So an actual loss would be more persuasive than an estimated one or a projected one. So that's what they're kind of getting at there, that actual, it may sound kind of funny, is due to fact. In other words, that it is, the actual amount is known and not estimated. So when we do the classical sampling or monetary unit sampling, we're making an estimate. We're estimating what these accounts are off by. That's different than the actual fact of what an account is off by. So an actual fact could carry more weight to it just because, a couple of reasons. First of all, that it is an actual amount that is not projected, that it's off by. But also when you run into things that are off by a fact, and if it's material or close to it, that carries more weight because it opens the door up that there might be more. Right? If you find something that's off, misstated by quite a bit, even though it's not at that up to that threshold of the total level, you need to be you need for to be quantitatively material. It might open the door up that there could be more wrong, and so even though it's under that, because it opens up that opportunity that there could be more stuff wrong, and it's a fact, you could actually point to it and say this is off by exactly 50,238 or whatever it is. That carries more weight. But that is kind of an odd one. Okay, problem 2. I don't think we talked about this. This is new, I think. Flow testing for assertions. I know we didn't talk about this. Okay, we start out with our source documents, and this could be anything from Invoices, receiving reports, shipping documents, these will all be source documents. Those get turned into journal entries. They could come from special journals too, these the source documents here. But then those go into the general ledger. And from the general ledger, we go to the trial balance. And from the trial balance, we go to financial statements. Okay, now here are the two things that we are generally testing for when we look at these testing for assertions. We're talking about this flow of documents. And we talked a little bit about this earlier, but completeness and existence. I put it up here somewhere. Here, these two. I'm going to copy this down here. Do I have room? I think I got room. So this is just from earlier in the document. I'm just going to paste this in here. So existence is book to floor. This would sort of be like the floor, if you would, here. And all the way down here would be the book. So we check for the existence. We go book to floor. Okay, here we have it on the financial statements. Let's go backwards and see if it's, the inventory's on there. And if we're looking for just simply at the statements, okay, we have the inventory on the books here. Let's go back to the source documents and we'll look at the receiving report. The receiving report will tell us if it was received. And just the opposite for completeness. You find some documents and you go forward and you go, okay, here's an invoice. I want to make sure that this invoice actually shows up on the financial statement. So you're going forward. Now there could be anywhere in between here that you test between. You could test between the journal entries and the trial balance. You could test between the source documents and general ledger. They test this on the CPA exam, not crazy extensively, but they almost always test something like this on the CPA exam as for existence and completeness. And that, these are very common. You want to know that they have everything in the account and yet they don't have anything extra in the account, right? The account isn't overstated or understated. And this is how they, you test for it. So completeness and existence are big. Okay, tracing source documents to the trial balance would most likely be associated with which assertion? So source documents to the trial balance. Would that be completeness or existence? You can put it in chat if you want.
Is it completeness?
Yep.
Yeah. That's just because we're going from floor to like almost the book.
Yeah, exactly. It's going forward up this chain here. So you want to make sure that these source documents are in the trial balance. Now there is that going from the trial balance to the financial statements, but so you're testing to make sure that these are all included if it's complete. Tracing the journal entries to the source documents. So here's journal entries. We're going to trace it back to the source documents.
So that one would just be existence.
Yep. Yeah, you have these source documents now. the journal entries. I mean, do you have anything to back up the journal entries? In this journal entry for sales, do you have anything to back it up? Shipping documents, whatever it is. Which the following most likely be associated with the existence assertion? So does it exist? It's kind of the same way. It's worded differently, but it's kind of the same idea. So existence is sort of like book to flow. What do you have on the books compared to what? In this case, could be book to source documents or financial statements to source documents. But we're trying to see if what they have on there exists. And down here we have this. I didn't put all the hold on here. I'm missing something. I haven't learned to copy and paste very well. And Florida book means that everything is included in there. So coming down here, which the following would be likely with the existence assertion?
It's A, right?
Actually, it's going to be B. So does it
Oh,
exist? So you look,
oh, okay.
yeah. No, these are they're kind of tricky to go through these. It's
I just got mixed up, yeah.
yeah. Okay, which the following would be the completeness assertion? Sales journal would be here. So here's a sales journal. So you're going to see if it's complete. So you trace the
Oh,
sales.
this one's B.
Yep. Good. Yeah, you're going to take the sales journal. You're going to go forward. Make sure that the sales journal ends up in the trial balance, and then do the book thing. So yeah, these are kind of the assertions, and the two that get beat up the most are going to be these completeness and the existence. Those are two assertions that get beat up quite a bit, and especially for things like inventory, uh, their completeness and existence are those are two of the most important things because you'll notice that inventory, for let's say Walmart, inventory triggers their sales. How much sales they have is based on their inventory, how much they sold, and what's left in the inventory will determine how much that inventory costs. So they get very it's very important for companies that, especially retail businesses, to get those inventory is very important account because it tells you what the sales are, it tells you what the cost of goods sold are. Those are usually the two biggest numbers. Well, almost always are the two biggest numbers on the income statement. Oftentimes, they're the two biggest numbers on all the financial statements are the revenues and the cost of goods sold. So getting those two numbers right is really important, and they do that through testing for completeness and existence. Okay, I'm going to send out the multiple choice questions, and I'll put the poll up. And let's say we back at we're done with this thing. Hold on, let me just go ahead and pull it up, and then I will send it out. That way you guys can start looking at them, and they'll be in your email shortly. I just realized I was there's a flaw in my plan here because I have to go through here to do send email. Okay, so if you want to Oops, no, not that. So I will start the poll. And we'll say be back at, what time is it? Well, let's make it 3:10. You can get started on this anytime. Before or after you on break or whatever. Oops. So you should get that soon. Yeah, the first three are up here. When I was when I was working for Navistar, we had an engine plant in Indianapolis that almost everything we made was sold to Ford. We made the diesel engines for Ford pickup trucks. We made all of them pretty much. And this is a assembly plant in Indianapolis. So something like 95% of our output went to Ford, and we really didn't make any money on those. But anyway, I was doing you know, I was the inventory guy, and so I did the floor to book, looked at the engines that were on the floor, got their numbers, went back, found them in the books. And then I was doing a book to floor, and I ran across this engine that was $20,000. And most of the engines at that, this is years ago, this is 30 years ago or more. Most of the engines were like 3,500, maybe something around there. So this engine was a $20,000 engine. So I was like, oh, just being a guy that wants to see a $20,000 engine, it'd be like seeing a $50,000 engine today or something. It's like, oh, I want to take a look and see what this thing looks like, right? So I'm looking around for this engine. I can't find it. I can't find it anywhere. So there's this engine that's supposedly worth $20,000 that I can't find. I'm asking all these different people, and finally I go down. I'm in the production area, and I want to find one of the production managers, and he said, is this some kind of special engine that we made, or what? He said, that's not a production engine. Oh, well, what is it? He said, well, it's those numbers aren't. That's not a production. That's not an engine that we sold. I said, oh, okay. Well, they started talking around to people and finally got to quality control, and it was what they call a mule engine. It was an engine that was designed to. It was a normal engine that was machined to very high specifications. It was exactly, there's always variations in anything you manufacture, and this one was as perfect as they could get it. And they would test it to see, okay, aside from manufacturing errors and so on, how durable is the thing? How much, excuse me, how much power does it put out? How long does it last? All that kind of stuff. And they were developing it to go into boats. And I guess boats have a very different. Boats run at high RPM a lot, and so more than cars. Cars, they start up and they go to hit a stoplight, they stop, and then they light changes, it goes, and so on and so forth. But with a boat, they just kind of run 80% all the time. Is very common. So they had to, they're doing durability tests because we were going to sell those engines to people who had for boating, and so we wanted to make sure that they were good engines and all that kind of stuff. But anyway, the sad part of it was that the engine looked exactly like every other engine. It was all internal. It was just done to a higher level of machining. All right, let's take a look here. Is anyone still working on the multiple choice? If you are, that's fine. And you just don't put it in chat or something, that's fine too. Anyone still working on the questions?
Yeah.
Okay. Okay, let's take a look. See here. Um, Question one. We have too many answers for question one. Question one. Which form is filed when the company changes auditors? Is the form 8K? Isn't that's not just for auditors, but that's anytime anything happens in a company, they send out the form 8K. So anytime something changes in a company, they fill out an 8K. Number two is split. Which the following statement is correct to a potential successor auditor, new audit client? Successor auditor has no responsibility. Yes, they do. Successor auditor obtain permission. This is true. Should contact the president regardless of whether no, you have to get permission from the client, or else they won't talk to you because it's confidential information. No, You're supposed to contact them before they take the audit. So B is the. All right. 3, the risk to detect material misstatements, substantive tests. Yep. 4. Ooh, 4 is split. Abnormal fluctuations. Oh, this one's a little bit tricky. The tricky word here is identified and the planning phase. Okay, so this is in the planning stage, not when you're actually doing the work. Now, D is when you actually be doing the work. And so it's not that this is such a wacky idea, but the best answer is going to be in the planning stage, where you're going to identify it, would be analytical procedures. And if you look at these, this is the only one that's actually done in the planning stage, the analytical procedure. So again, yeah, you are going to do these tests of transactions and balances, but these will be identified in the planning stage. One thing about by the way, these are all CPA questions. These are actual CPA questions. Is that they're very specific. I don't know if I told you this, and I met a guy that actually did wrote CPA questions, several CPA questions, and we talked about how long does it take you to write a CPA question. He said multiple choice questions take 8 to 10 hours to write because they have to be very specific and they can't have anything else come into play. Everything has to be self-contained in that that question. So they're very specific as far as what they're testing. Okay, number 5. Oops. Unsupported entries in the ledger. The direction of audit testing should be from the ledger. So you're going to go to ledger, go back to the source documents to see if they are if they actually exist. So this is your testing for existence. It doesn't tell you that, but let's make that yellow. Number 6. An auditor looks a sample of a file of shipping documents to determine whether the invoices were prepared. This is satisfy the objective of completeness. That's a source document going to the see if the invoices are prepared. That's kind of a tricky one too, but it's make sure that everything that was shipped was actually an invoices prepared that would go into the sales journal. Good. Tracing from source documents forward. Completeness. Which I find would most likely an auditor conclude that a potential audit engagement should be rejected. And B is correct. Okay, yeah. He's the best answer there. To test existence. Or would sample from the general ledger to the source documents. That is right. Question 10. The predecessor. So this is the old auditor. Is required to attempt to initiate communication The old auditor isn't required to do anything. It's up to the new auditor. Successor auditor is required. This is a tricky one because that. The predecessor auditor is going to be the old auditor. And the old auditor doesn't have to do anything. The new auditor is required to contact the old auditor. So the successor is the new auditor's, the new auditor coming in, and they're the ones that are required. Okay. Very good. I'm going to stop sharing. I don't like sharing anyways. I'm going to download the results. What is this, chapter 6? It's a blank screen. Okay. All right. Any question on that thing? All right. I'm going to stop here. So I'm going to send out the exams, the chapter 6 exam. I'm not going to start it on the sampling overview. We can usually do that in 1 hour. Usually we can do it 1 hour, so we'll do that next time. It'll help split up the class next time because when we start talking about internal controls, and if you thought chapter 6 was a little bit dry, internal controls is even less exciting. But anyway, so I will send that out. The exam judge, I'm going to check through, make sure the exams are okay to send out before I send them out. But certainly by like 8 o'clock tonight, you should have the exams, hopefully sooner than that. And they will be due, they say on the 4th or something? 5th. Friday the 5th. So I'll send these out. You should have these by like 8 o'clock tonight. And you guys get the extra credit points will be added into your score, obviously. Okay. So we'll do this next week. Okay. Any questions? All right. Enjoy your day and look for your email. It should be coming certainly by like 8 o'clock. Hopefully I'll get them out sooner, but you should have your the chapter 6 exam, 5 and 6 exams should be in there. Okay.
Sounds good. Have a good one.